If you have $1 million saved for retirement here in Canada, first off, congratulations. That puts you in the top 1 percentile of Canadians, and it's a testament to decades of hard work, smart choices, and disciplined saving. Congrats, you made it. But I want you to listen closely to what I'm about to tell you. Having $1 million doesn't automatically mean you're financially secure. What matters far more is how that million is invested, where it's invested, and when you plan to use it. In today's video, I'm going to walk you through the exact investment blueprint I use for my high net worth clients when they're retiring with $1 million. We're going to talk about asset allocation, tax efficiency, cash flow generation, and longevity proofing your portfolio so you don't run out of money at 75, 85, or 95. So whether your $1 million is sitting in an RRSP or spread across TFSAs and a corporation, or it's invested in a mix of real estate and stocks, I promise you this, today's breakdown could easily save you tens of thousands of dollars in taxes and years of financial stress. I'm Rob Tétrault. I'm a senior portfolio manager and branch manager here at the Tetrault Wealth Advisor Group. We specialize in helping high-income Canadians protect, grow, and transfer their wealth tax efficiently. These are the 3 biggest mistakes that people make when retiring with a $1 million portfolio. Let's get into those mistakes right now. First mistake, investing like you're still in your 30s. Let's start with what not to do. I see far too many people heading into retirement still investing like they're in their 30s. They're overweight in growth stocks, they're overexposed to tech, US markets maybe, or chasing returns without a plan for liquidity. That might have worked while you were earning a steady income, but in retirement, the game is a little different. Your $1 million nest egg is no longer like a scorecard. It's a machine. It needs to generate reliable income. It needs to last 30 plus years, and it needs to respond to taxes, inflation, market volatility, and potential late life costs. And it needs to do that all with one portfolio. So what's the move? Well, we shift the mindset from max growth at any and all costs to what I call risk-adjusted lifetime income planning. That means we're designing a portfolio where the number one objective isn't beating the market at all costs. It's making sure you never have to unretire. So that'll likely include some alternative assets, maybe a little sleeve of fixed income in there, and not necessarily having every one of your positions in a max growth stock. Mistake number 2, messing up the bucket strategy. So here's how we break down that $1 million. We divide it into 4 distinct buckets, and each one has a different job. All right, your bucket 1, your first bucket, is a cash-like reserve, and this will hold anywhere from 12 to 24 months of your living expenses. Now, it doesn't need to be in cash or high-interest savings or a GIC or a money market. It can be in, short-term fixed income or bonds or something like that, but the idea is that it's going to insulate you from short-term market volatility. We want to have liquidity. We want to have something that we can convert to cash if the market tanks and we're able to give you the income you need in your retirement. When you were in your 30s, if the market fell 20 or 30%, you didn't want to sell those stocks. You didn't have to sell those stocks. But now that you're in retirement and you need to draw down, you need living expenses, we have to think about that, right? So 12 to 24 months, short-term fixed income type investments, it's going to be there. Liquidity, stability, safety. Your second bucket is conservative income. So this might be, some alternative assets, some private credit. This is kind of your 3 to 7 year money. It needs to pay you while you wait, preserving principal. We're big believers of alternative assets and they fit here. So most Canadians don't have enough of this. It's a great diversifier. It reduces your risk, increases risk-adjusted returns, and it's incredibly tax efficient. So we like to have conservative income, think alternatives, think, maybe some private credit or some music royalties, stuff like that. The third bucket is going to be your long-term money. Think of your 10-year plus money. It can be US stocks, Canadian stocks, some global stocks, or potentially some real estate growth plays. It's designed to outpace inflation, preserve your purchasing power down the road, and give you kind of the alpha in your portfolio, give you the returns in your portfolio. The best part is you won't need to touch this during the next market downturn because you got buckets 1 and 2 doing the heavy lifting if ever there's a market correction. Bucket 3 provides the growth. Bucket 4, I'll call it opportunistic and legacy. This is where things can get customized. For some clients, this might be charitable giving bucket or investing in grandkids RRSP, or maybe it's setting up a family trust. And for a few, this is their play money. Maybe you want to do private equity or angel investing, or you want to invest in limited partnerships to do real estate investment. Maybe it's something you're passionate about. Either way, it's separate from your retirement cash flow engine. And usually it'll be a smaller piece, the smallest bucket of all of them. Mistake 3, tax efficiency. We see this all the time. Let's talk because this is where most million-dollar portfolios leak value like a sieve. The majority of my clients come to me with all their savings in RSPs, and that's a big problem. Why? Because RSPs are fully taxable when they're withdrawn. And once you hit age 72, you're forced to convert them to a RRIF and begin drawdowns, right? So what do we do instead? Well, we layer withdrawals. We create income from non-registered accounts first, maybe even draw a little from your RSP between 60 and 71, delay your CPP or OAS if we can to help reduce your tax bracket. We also want to be strategic about your TFSA. It's not just a savings vehicle, it's a retirement income firewall, and we use it to top up income while avoiding the OAS clawback. It's great because it's liquid and it's accessible and it's convertible to cash, and you keep the contribution room the following year. The key idea here is the order in which you do this. The drawdown, the right accounts in the right order to keep you in a low, consistent tax bracket for the rest of your life. Let's look at the real story of Jennifer and Marcus. They were 62 and 60, had $1 million between them, $600K in RSPs, $150K in TFSAs, $250K in non-registered. We built a 30-year retirement income plan. We drew $35,000 per year from their non-reg for the first 5 years. We topped it up with TFSA withdrawals and we delayed CPP until 70. By doing this, we avoided the OAS clawback, we smoothed out their tax bill, we kept their effective tax rate below 17% for nearly 2 decades. Even better, at age 95, they're projected to still have $640,000 in assets. Even with inflation and rising healthcare costs factored in, they are miles ahead of where they would have been had they not had a proper financial plan put into place. So here's the truth. Investing $1 million for retirement is less about picking the hottest stock or beating the market by 5% per year, and more about engineering the right structure to create reliable, tax-efficient income for life. If you want that kind of structure, if you want to know exactly when to draw, how to make sure your money outlives you, I walk through all of this inside our retirement planning masterclass. It's completely free, it's packed with case studies and tools, and it's designed specifically for Canadians like you who have $1 million or more saved. Click the link in the description to register now. Don't forget to like and subscribe, and check out my YouTube channel if you want to see more content like this. I post fairly consistently, and I'd love to see you there. I'm Rob Tétrault. Thanks for tuning in. I'll see you in the next video.